Since we're on the topic of Jackson Hole and the US and what the markets are doing out there as well, let's get in an important global voice. Michael Every, he's head of Asia Pacific Financial Market Research at Rabobank, joins us right now on the phone line. Michael, good morning. Thanks so much for joining in. On expected lines, yes, but the money markets as well as the speech from Jerome Powell seems to price in a September hike for sure. The question mark only remains over the pace of hikes post that.
Well, yes, that's correct, but that's really the big issue, because I don't think there's any doubt in anyone's mind that a month from now we'll be 25 basis points higher in Fed funds than where we are today. But there's huge disagreement on what the long-term glide path is after that. You know, the Fed seems to be saying pretty clearly and pretty consistently that there'll be another 25 in December after that, and between 3 and 4 hikes in 2019. And, maybe another 2 hikes in 2020, if not more, depending on how the economy performs. And if you look at the market, measure after measure is basically saying we do 25 in September, and we might do 25 again at some point in the future, and that's about it. So you've got, something like 125 basis points of disagreement between the market and the Fed over the next 18 months. And someone's going to be wrong. Let me make that really, really clear. Someone's going to be wrong.
Yeah. So the bear thesis on the markets, which is caused in part by they believing that the pace of rate hikes will be faster than what people are figuring in right now, Michael, is driven by rising inflation caused by full employment. I think almost all of that camp is pointing towards how US has already hit full employment because there are more vacancies than employment opportunities available. And that will in part push wage inflation higher sooner than what the bulls might be hoping for or believing, and that will lead to inflation higher and therefore rates at a much higher trajectory. Is that a valid argument, and would you reckon that could well lay the ground for a faster trajectory of rate hikes, if not in 2018 then in 2019?
Well, if we were to see that, and that's the big question, if we were, then I think everything changes. Because absolutely, once you start seeing wage inflation, rightly or wrongly, and on a personal level, I think wrongly, the Fed will be then looking to raise rates quite aggressively because they're happy when house prices go up and they're happy when equity markets go up. They're not happy when actual wages go up, which is part of the reason why we're in the global problems that we're in. The bigger picture, though, is that going to happen? Because if you look at traditional models of how the U.S. labor market works, it should already have happened. And actually, it hasn't happened up until now. And I think you have to posit the theory, it's a hypothesis, that due to globalization, due to deregulation, due to technological changes and the entire structure of the U.S. economy, it doesn't operate the way that it used to. I mean, you don't have to have full employment at the level it's at now and say, therefore, you'll get wage inflation. And, for example, I look at emerging markets as a guide. I've been arguing this for years. There are emerging markets I could name. I won't actually give you the name here now, but these are real countries not too far from India, where you have 1% unemployment pretty permanently, never fluctuates around 1%, or far from 1%, I should say. And you don't have wage inflation, apart from in 1 or 2 lucky sectors. So, if you have a highly atomized labor force, then you actually don't end up with wage inflation no matter how low unemployment goes. And perhaps the US is there now.
Okay, Michael, in which case, one final question. What does all of this mean for markets? I mean, there's no positive or negative surprise that's coming from the Jackson Hole, more steady case. I think from emerging market perspective, Turkey comes back to action this week after an extended holiday. There's talk of some U.S. action against South Africa, Russia, and the constant simmering between U.S. and China. How does this set us up for emerging markets in the near term, or Asia Pacific in the near term?
Well, near term is a relative concept because, there are many things you can look at and be optimistic about, and the recent trend in markets is one of them, or the momentum, I should say. But on a fundamental basis, everything you just flagged there, whether it's Turkey, whether it's Russia, whether it's the trade war with China, whether it's South Africa, all these different factors come into play. And as we move day by day closer to the September, markets are going to be day by day closer to finding out that perhaps, just perhaps, the Fed is absolutely serious and that they are either going to make a policy error in believing that wage inflation is imminent, when it actually isn't here yet, or that the Fed are right and that wage inflation is just a bit about to appear and raise its ugly head, at which point, yes, interest rates are going to get a lot higher, and I would imagine equity markets are going to get a lot lower.
Okay, well, Let's wait and watch how soon that happens. Michael Every, many thanks for joining in today and giving us that perspective. Really appreciate your time.